The current live price for Intel Corporation is $42.71, representing a significant intraday climb of $2.67, or 6.67% as we move through this Wednesday session on January 7, 2026. What most people watching the ticker symbols flicker on their Fidelity mobile app or scrolling through the Robinhood app might miss is that this move isn't just another tech bounce, it's a structural shift. While the broader market is still chewing on the latest inflation prints, Intel just proved it can actually manufacture at the leading edge. The common expectation for years was that Intel would perpetually trail behind TSMC, stuck in a cycle of delays and broken promises. The reality we're seeing today is that Intel's 18A process node is not just a laboratory success, it's in high-volume production, and it's powering the next wave of hardware that's hitting shelves this month. If you thought this company was a dinosaur waiting for its final sunset, today's price action is a loud, clear signal that the predator is back in the hunt. The heavy lifting today is coming from the CES 2026 announcements in Las Vegas. Intel didn't just show up with slides, they showed up with silicon. The launch of the Core Ultra Series 3, known by the codename Panther Lake, is the specific catalyst driving these heavy volumes on Interactive Brokers' trading platforms right now. We are seeing institutional money rotate back into Intel because for the first time in nearly a decade, Intel has a product that can look a high-end mobile chip from the makers of Apple stock in the eye and not blink on power efficiency. Investors who use Fidelity Brokerage or SoFi Active Investing are reacting to the fact that Intel is claiming a 25% improvement in power efficiency and nearly double the graphics performance in their new integrated units. This isn't just about faster laptops, though. It's about the foundry. The market is finally starting to value Intel's manufacturing arm as a distinct entity. We've seen reports of a pragmatic armistice with competitors, where even those who traditionally buy Nvidia stock are looking at Intel's advanced packaging as a solution to their supply chain bottlenecks. When you see a 6.67% move on a company with a market cap of over $200 billion, you know the big players, the ones managing Fidelity wealth management accounts and large-scale individual brokerage funds, are repositioning. They are betting that the national champion status Intel has effectively earned with government backing is finally translating into cold hard market share. If you're managing your own online investing through SoFi Invest or checking your Interactive Brokers account, you need to look at the volume profile of today's trade. We are seeing nearly double the average daily volume before the lunch hour. This suggests that this isn't just retail enthusiasm on the Robinhood stock trading platform, it's a breakout from a long-term base. For most of 2025, Intel was stuck in a range, frustrating anyone trying to invest online in a turnaround story. The expectation was that Intel would continue to bleed cash to build fabs that might never be filled. The reality revealed this week is that the order book for the foundry is actually filling up faster than the skeptics predicted. Let's talk about the competition for a second. If you look at Tesla stock, the volatility is driven by retail sentiment and future promises of autonomy. But Intel's volatility right now is driven by physical reality, the ability to etch transistors at a 1.8 nanometer scale. That is a moat that very few companies on Earth can cross. When people look for investment help or search through investing sites for the next big play, they often overlook the boring hardware makers. But without Intel's progress, the entire software side of the industry hits a wall. Even the most sophisticated SoFi robo-advisor or intelligent portfolio algorithms are starting to flag Intel as a value play that is transitioning into a growth story. Comment below how many shares of Intel you currently hold, or if you're waiting for a pullback to $40 before jumping in. I want to see how many of you actually caught this breakout, or if you were too focused on the high flyers in the AI software space. The daily swings we're seeing are also a reflection of broader macroeconomic pressures. We've seen a rotation out of some of the overextended names in the Fidelity ETFs that track the broader S&P 500 and into specific semiconductor names that have underperformed. Intel fits that description perfectly. While Nvidia stock has had an incredible run, its valuation assumes perfection. Intel's valuation, even at $42.71, still reflects a lot of doubt. That gap between doubt and reality is where the profit sits for the self-investing crowd. Whether you're using Fidelity Investments for a long-term IRA or flipping Robinhood fractional shares for a quick trade, the technical setup here is fascinating. We just cleared the 200-day moving average with significant force, and that usually invites even more momentum buying. Looking at the business model, Intel is essentially two companies under one roof. There's the Client Computing Group, which makes the chips for your PC, and then there's Intel Foundry. For years, these two were tangled together in a way that hid the true cost of manufacturing. Under the current leadership, that wall has become much more defined. The client side is now essentially a customer of the foundry side. This transparency is what the smart money at Fidelity Brokerage and Interactive Brokers has been demanding. It allows investors to see that the PC business is actually quite healthy and profitable, while the foundry is a long-term infrastructure bet that is finally starting to see its first major external customers. The old reports from 2024 and early 2025 were grim. We saw massive losses, layoffs, and a dividend cut that felt like a betrayal to long-term holders of Fidelity mutual funds. But those were the necessary costs of a total structural overhaul. You don't rebuild a global manufacturing empire overnight. The past performance was a reflection of a company that had lost its way, focusing more on financial engineering than actual engineering. But the 2026 version of Intel seems to have found its soul again in the clean rooms of Arizona and Ohio. The shift towards national champion status with direct government equity stakes and billions in CHIPS Act funding has provided a floor that wasn't there before. For those looking for investment opportunities, it's important to understand the role of advanced packaging. Intel's Foveros and EMIB technologies are becoming the industry standard for stitching together different chiplets. Even if a company doesn't want to use Intel's CPU, they might need Intel to put their chip together. This is a nuance that doesn't often make it into the headline of a Robinhood app notification, but it's central to why the stock is up 6.67% today. It's a diversified revenue stream that makes the company much more resilient than it was during the Pentium days. Now, what about the risks? The expectation is that 18A will lead to 14A and Intel will stay on top. The reality is that manufacturing at this scale is incredibly difficult. One hiccup in a fab in Arizona could send the stock back to the mid-$30 in a single session. This is why many people who use Schwab Intelligent Portfolios or SoFi ETFs prefer a diversified approach. But for the individual brokerage investor who likes to pick winners, Intel represents a high-risk, high-reward bet on the return of American manufacturing. If they can execute on the 14A roadmap, the current price of $42.71 will look like a steal in 2 years. Let's look at the sector momentum. Semiconductors are currently the engine of the entire market. If you're looking at Fidelity IRAs or Robinhood investments, you've likely seen the massive weight these companies hold. When Intel moves, the whole sector feels it. Today, Intel is actually outperforming many of its peers, which suggests a catch-up trade. People are looking at the price-to-earnings ratios of other chip makers and realizing that Intel is still trading at a significant discount to the sector average, despite having its own fabs. This is a point often highlighted on investing sites that focus on deep value. The future outlook for Intel involves a series of high-stakes catalysts. Later this year, we expect the first server CPUs built on the 18A process to hit the data center market. If Intel can claw back even 5% of the market share it lost to AMD in the server space, the revenue implications are massive. Furthermore, the partnership with Nvidia for data center packaging is a massive vote of confidence. It tells the world that the industry leader in AI trusts Intel's factories. This is the kind of investment help that a narrative needs to turn from troubled to triumphant. If you're using Robinhood Crypto or Robinhood Cash Management to park your funds between trades, you might be wondering if this is the time to rotate back into equities. The tension between the expectation of a tech bubble and the reality of solid earnings from companies like Intel is what creates these opportunities. While some parts of the tech world feel frothy, Intel's rally today feels grounded in tangible progress. It's not about a new app or a social media trend, it's about the physical building blocks of the digital world. In summary, the move to $42.71 today is a validation of a multi-year strategy that many thought would fail. Intel has managed to break through the $40 resistance level, supported by heavy institutional volume across platforms like Interactive Brokers and Fidelity. The expectation was that the 18A process was just marketing. The reality is that it's a functional, high-volume manufacturing node that has put Intel back in the leadership conversation. We've seen a shift from a company that was too big to fail to a company that is too important to lose. Whether you were managing a SoFi robo-advisor account or doing your own online investing via a Fidelity trading platform, the lesson here is that execution eventually overrides sentiment. Intel spent years being the punchline of every joke in Silicon Valley, but by focusing on the core engineering and